Good afternoon, ladies and gentlemen, and welcome to the penultimate session of Boston FinTech Week. This workshop is entitled An Exclusive Conversation with Katherine Collins, Head of Sustainable Investing at Putnam. I'm your host today. My name is Kevin Bourne. I'm the co-head of Sustainable Finance at IHS Markit. We are a leading provider of data, technology and research services, financial markets and key industries. During the session today, I'm going to be posing a series of questions to Katherine, looking at how ESG, environmental, social and governance, is changing the investment landscape around the globe, and also the key drivers of this movement that have become such a global business and regulatory imperative. In my 30 years in financial markets, I simply have not seen anything move or transform Katherine and my industry as quickly as ESG. It is an unstoppable movement. FinTech plays an important role as an enabler for ESG solutions. We both see that in our daily work, whether it is a bank, a fund manager, a hedge fund, an insurance company. They all look for advantage at a time of ever-increasing risk and change, mostly because of climate change. So who is Katherine? Katherine is currently the head of sustainable investing at Putnam Investments and a portfolio manager in her own right for Putnam's Sustainable Leaders and Sustainable Future Strategies. This has approximately 8 billion in assets under management, so that's a lot of other people's money. In addition to her investment role, Katherine is both a successful author and hopefully a successful beekeeper. She's telling me about being a beekeeper earlier. That is an extremely important credential. It's one of the best I've seen from anyone on a bio for a long time, being a beekeeper, and I am very, very envious. Katherine also serves on several non-profit boards and gives back, including the Santa Fe Institute, the Amiga Institute, and the Harvard Divinity School Dean's Council. Katherine's been recognized for her work in sustainable finance, and this year in 2021 she was named to the inaugural Forbes 50 over 50 list of leaders who are shaping the future of finance. And if one issue is shaping the future of finance, it is sustainable investing and ESG. So, Katherine, we'll start with the questions. So ESG and by default, climate risk are such important subjects for investors in a world that is quickly waking up to a new paradigm of very, very serious risks. I'm sure the audience would appreciate from you, because of your role, both a high-level strategic and also a low-level tactical perspective on how this impacts a fund manager like yourself and a business like Putnam, who are controlling several $100 billion of investors' funds.
Yeah, Kevin, thanks so much for that thoughtful framing, and thanks everyone for joining the conversation today. I'm glad we're going to start with a little bit of a strategic view, because we'll dive deep into some of the specifics about the intersection between sustainability, ESG, and the FinTech community, but to really have that broader setting in mind, I think is key. In short, these are the issues of our time. The environmental challenges we're facing, the social challenges that are intertwined with them, are really at the core of all of our existences, and we don't need any better or more pressing proof point for that than our collective experience of this last couple of years. Given that that's the environment that we're all working within and living through at this stage, there's a really matter-of-fact premise that informs our sustainability work at Putnam and our investment focus, and that is that if these are important issues in the world, they are going to impact the companies we're invested in, they're going to impact our own processes, and they should be incorporated into those processes in a context-specific way, a way that is really relevant to our goals as investors, not sitting off to the side, not only an exercise in paperwork, but really integrated into the core research and analytical processes that drive our decision making. So that's the setting that we operate within. Maybe one more note on my role at Putnam. I am a long-term fundamental investor. And so this means that we are trying to figure out the details and the prospects for the companies we invest in all day, every day. And so that's a little bit of a different perch from someone who's focused on taking purely quantitative approaches to investing, or someone who's more in a trading function or a reporting function. So we'll talk about some of those different perspectives as we go, but it's important, I think, to disclose at the beginning, my focus is on where these issues meet the world and how that influences the prospects for long-term fundamentals and investment outcomes. And it's at that intersection where you find some really fascinating things happening. The last thing I'll say, just to set the stage, is that almost by definition, a lot of what falls under this umbrella of ESG is risk oriented. But as active managers, we're really focused on the opportunities that arise through this period of pretty dramatic change as well. And so there are opportunities on the investment side. There are also opportunities, as we'll discuss, for the whole ecosystem that surrounds that investment function. Whenever something is changing, almost automatically, it means that the solution to the new challenge or the more acute challenge is also potentially more and more valuable as things progress. So sometimes these conversations take a little bit of a glass half empty, risk only view of things. And I don't mean to dismiss that. Risk is a very important function and a very important consideration for all investors. But the flip side of risk almost always is that somewhere there's a solution or an opportunity that's connected to that risk. And so I want to make sure we keep all those dimensions in mind as we dive in.
Thank you. Clearly, it is interesting to hear, and it's very fulfilling to hear that this is a whole company issue for you. I think for most people in our industry, the deniers have long gone away. Maybe a few years ago, we now understand, because we see it in what is happening, the impact on companies and the impact on regulation. So in your role as head of sustainable investment, you are undoubtedly seeing the regulations linked to ESG and climate risk arriving at an ever increasing rate. We have a saying in England, it's like buses in the rain. You wait for a long time and suddenly 10 come along. It is clear that these regulations are, however, very often multi-jurisdictional rules that are being applied to financial institutions as well as the companies and countries they invest in. So just perhaps some observations on how regulation is really having an impact on your role and how you think it might change in the future.
Sure. So regulation obviously is a hugely important consideration, and it certainly sets boundary conditions, reporting requirements, a lot of other standards of practice for investors as well as issuers of securities. When I think of regulation, one image that's helpful to keep in mind for me is kind of a Rubik's Cube, with 3 dimensions to it. There's more dimensions than that, but three you can kind of hold in your head at one time. One set of dimensions, which you already alluded to, Kevin, is the geographic dimension. This is not an area where we have a coherent global policy that is really consistent from region to region. And in fact, that might be totally appropriate. The issues and the context do vary from one part of the world to another. And so the regional variance is something that's really important to recognize at the front end. The second dimension for my consideration is the vector of focus for the regulation and reporting. To me, there are 3 main layers here. One is a rise in reporting and regulatory requirements for operating companies and entities that we're investing in. So issuers of securities of all sorts have a lot of changing regulation that they're managing, sometimes specific to their business, sometimes more broad-based, all public companies, for example. So issuer level regulation is one element. There's a growing focus on portfolio level regulation. This takes a few different forms, but the idea that there might be different reporting requirements coming at an investment product level is something very, very key. And again, it varies a fair amount from one region to another. And then the last is regulation at a corporate level, not necessarily corporate issuer, but asset owner, asset manager corporate level. And so, again, that's a little bit of a different dimension. It's looking at the full range of operating activities at a firm, potentially the full range of risk that sits within a given firm for their whole book of business, as opposed to one investment product. So many dimensions in that regard. And then the last thing I would highlight is that the form the regulation takes also has quite a bit of variety. One arc of questioning has to do with proof of process, being able to track what you're doing and why, and how it aligns with all of your other types of disclosures. Another is looking at proof of characteristics or the results of that process on lots of different dimensions. And then the third, most open-ended arena is there's a huge interest in really assessing true impact over time. This is definitely the hardest analytically, as anyone who's worked on impact assessment will recognize. But to me, that's kind of the furthest out layer. So again, it's a very complicated landscape. It's not unnavigable. But because it's such a complicated landscape and changing very quickly, it's right that you highlight it right off the bat. This is an area where solutions providers, I think, really have a chance to add an extra amount of value given the very dynamic context.
And that's a very important comment, because we are today speaking to lots of young technology companies. And I must say, as a user myself of information and regulation, it is not an easy subject to get to grips with, and it's difficult sometimes to locate data. A supplemental question to that, because I'm sure that you are facing exactly the same regulations that all of fund managers are facing. Do you think we have too much regulation, or do you think that's a price we have to pay for the 250 years we've taken to create climate change?
Well, the answer might be embedded in your question there. I think it's not hard at all to see why regulation is accelerating the recognition of the challenges that we're facing, particularly on the climate front. But I don't want to forget the S and the G in ESG, right? The issues of our time are increasingly vivid in their revelation, and therefore it's not surprising at all that there's a really important role for regulation to play. The thing I would highlight, though, is that at a philosophical level, a very deep root level, there's a real challenge here, always, if you're trying to regulate something, particularly with a rules-based approach as opposed to a principles-based approach, and the thing you're trying to regulate is evolving very quickly. Almost by definition, there's going to be some tension there. You want to have a structure that will stand the test of time, that will really not have to be constantly moving around and shifting, and yet the essence of the thing you're trying to regulate and be better informed on it and kind of reinforce is itself very dynamic. And so there really is a bit of a riddle here for regulators. And again, they're trying to solve it in different ways, in different settings.
Yes, and that's a very relevant point you made. We have become used to very sensible markets-based principles legislation and rules that we work with sensibly, but we are increasingly seeing around the world rules-based domains coming in on the basis we simply don't have time to work through with the luxury of a principle, and the market is being told how to react. And I'm just going to give one example to the audience, because it's something very topical, because I'm based in the UK, about 40 miles south of London. I'm probably slightly nearer France than I am London. That's happened yesterday and today. About 10 weeks ago, the UK government said, if you are a supplier to the UK government of goods and services, and the contract is worth more than about $6 million, on the 30th of September / 1st of October, if you are bidding on a contract that's a new contract or renewing a contract, you will have to submit, whether you are a public or a private company, a full net zero business plan. First, we're the first country in the world to do this, and speaking to other countries, many of them are going to do exactly the same. So that's very significant. If you do not submit a net zero business plan, you are not allowed to bid. It's that simple. And I can see, as I said, I can see many other governments around the world doing it. Now that, just as an event, is very important for Katherine in her role, because if companies suddenly start losing major contracts because they cannot make net zero, or they cannot submit net zero plans to a customer, in this case the UK government, that is something they'll have to think about when they're assessing whether they're in a portfolio or not. That legislation was thought about in detail publicly about 10 weeks ago, and it came into force yesterday and today. I've never seen legislation with such an impact move so very, very quickly.
Quickly. Yeah. I mean, Kevin, you're highlighting something really important, which is that both this question on regulation and also the broader question about ESG analysis and data use more in a more complete setting, they really serve different functions in different settings. And so one way that has helped me to think through the question of purpose that goes with both regulation and analysis in this arena is that there are certain cases where the purpose is a very compliance-oriented purpose. There are other cases where it's a risk assessment, risk management, risk mitigation purpose. And then there's a third set of cases where it's really alpha generation or performance enhancement purpose. And these three dovetail in very important ways, but they're not the same thing. So the processes and procedures and tools that you set up for compliance may or may not be the same processes and procedures and tools that are helpful to you in making good investment decisions. And so to keep that in mind and not constantly be thinking of ESG as sort of a monolithic thing or one particular regulatory approach as like the global approach is a really important kind of design element to where we are right now for anyone working in the field to make sure that we're not extrapolating from one setting to another too quickly is a really key consideration.
And to a point you made just now, many of the new regulations seem to be focusing specifically on climate change rather than broad ESG. The S and the G do seem to be disappearing sometimes, although there's been some activity around supply chain risk for human rights and for child labour coming from certain countries in Europe and the UK and Canada potentially. But it's clear to us, and therefore clear to, I know, to yourselves, that investors are increasingly being asked to measure three very specific types of climate risk. And interestingly, these were defined by Mark Carney, the ex-governor of the Bank of England, in what I think is now going to become a very famous speech he made in 2015, entitled "The Tragedy of the Horizons," at Lloyd's of London, the insurance market annual dinner. And if you have not read that speech, it is not about financial markets. The Tragedy of the Horizons is an excellent way of encapsulating the realization that the problems are of a scale that we have never seen before. What was important in that speech, and what has now become part of the regulatory framework internationally, are three key definitions of risk. And I think it would really help the audience to understand what these mean for you as a fund manager. So, and I'll take you through them in order. So the first one, physical risk.
Sure. So so you're right. This is a very kind of formative talk and a really essential structure for thinking about the nature of risk. Physical risk is pretty straightforward. It's the actual risk to assets that we have in the world. So, for example, you could have the most beneficent company imaginable operating on the shores of the Mississippi River, and if the river rises and the operating entity is wiped out, all of that benefit gets wiped out. So it's the risk of actual, tangible property, plant, equipment, other infrastructure in the world. So a very specific look at risk, and again, not always easy to identify if you're looking at a big global corporation and trying to assess physical risk on a planetary basis.
The second one, and what was interesting for me in President Biden's executive order on climate change, this was the one that was not included. So I will include it to try and redress that balance. Liability risk.
Sure. So liability risk is an interesting one, and it relates very directly to the challenge that we have for climate change of the whole broader concept of externalities. Pretty often, the organizations that are responsible at the front end of the process don't have a responsibility that loops through to the end of the process. And so the notion of liability, I prefer a maybe more philosophical approach of responsibility, because liability is a very specific legal definition. As an investor, I'm even more concerned with kind of this broader implication that one way or another, the responsibility might come back to roost with a company that is generating, activity that potentially causes harm or impacts the planet. Again, I'm careful about my language here, though, because I think even the term liability implies something much more precise than currently exists in the world.
Yes, I've been picking up recently. Liability risk I think, is becoming an interesting one, and much of the commentary on liability risk I'm reading from the law firms around the world is saying, what happens if companies or governments don't meet net zero?
Right.
If you've made a declaration as a public company that you are going to be net zero by 2050, and you are adjudged and measured not to have made net zero, but you've made the declaration, you have a significant potential liability. And therefore, the boards of directors today and the chief executives who are making these statements are making their company beholden to a liability risk over time.
Yeah. Well, and Kevin, before you get to the third one, I just want to note on that front, we're going down a very kind of vital but wonky legal path in terms of the risk potential for climate change. My focus as a fundamental investor is most of the time to take a big step back from that and just say, what is this company doing that is beneficial in the world? If this company were 10 times bigger, would the world be obviously better off or not? If I'm fast forwarding 10 years into the future, is the business this company in going to be harder or easier to manage because of all these different forces? And so I want to make sure that as we're talking about these really important tactical points, that we're, again, kind of orienting back to that bigger context that other decisions sit within.
Which plays
not only a legal issue we're talking
which
about.
plays exceptionally well into the final risk.
Yeah.
So transition risk, the structural change from a high to a low carbon economy. One of probably the greatest industrial transitions since the late 18th century, when we moved away from being an agrarian society of a scale I think people have yet to comprehend. So transition risk for you as a portfolio manager.
Totally, you're right. What I just said is the perfect lead into transition risk. This is asking the much more kind of foundational question of how will the world look different as all of this proceeds into the future, both on the regulatory front, but also in terms of the actual planet and the organizations operating within it, changing what we're doing and why. And so to me, transition risk is the most open-ended in some ways, the most creative area to explore as a fundamental investor. Again, I don't want to dismiss the seriousness of the challenge in front of us. It's precisely because of that seriousness that the transition opportunities are just enormous and almost as broad-based as the risks, maybe even more so. So when we think of any issue that is so pervasive across all different geographies, all different operating settings, the range of potential solutions that are going to be helpful in that kind of setting is similarly broad. And so to me, these first two categories are very important and relatively narrow in terms of the analytical insights that they bring, vital but specific. This last element is much more open-ended, thinking about the future operating state of the world and what that might mean.
Yeah, a big issue. Thank you, Katherine. So we all now have a clearer picture on the scale of the challenge for financial institutions and investors like Katherine and Putnam. The regulators want us to explain and model ESG and climate change on all financial activities. This, of course, should be a golden opportunity for the people in the room to build tech solutions to help us all navigate these stormy waters. But as we all know, having a big idea and delivering this to financial institutions is notoriously difficult. Both Katherine and I have had our own businesses, so we understand these challenges at a very intimate level. So perhaps now we can just spend a few minutes thinking about what the key challenges might be for tech companies. And for audience clarification, Katherine's business and Katherine do not invest in young FinTech companies. There's no point in emailing her your business plan after this session. But she does use multiple tech capabilities on a daily basis as an investor. And it's the work you're doing as FinTech companies that feeds through to us and to Katherine's business. So these are some pointers over the things that we think of. So Katherine, firstly, a question to help all of the company builders online think about client needs. If I can ask you to place these capabilities in order of preference, it should help our audience think about your priorities as an investor. So I've not put these in any order other than it's random. So number one, a company that builds innovative analytics that present really exciting ways to view data. Number two, a company that builds operational processes that help drive efficiency in our back offices and down in the machine rooms. And number three, a company that builds new and original data sets.
Oh, that's interesting. I would flip those around in terms of order of importance. A lot of companies do some of all three of those things, but you can easily spot the offerings that are more focused on like a neat user interface as opposed to better underlying data. And one thing we've already touched on, but it makes sense to underscore 3 or 4 times. If you have primary data that is actually more insightful than what we have now, that is a gold mine. You can build all kinds of things off of that data. We're in a phase right now, partly because of the backdrop that we've just been discussing with a lot of different layers of operating complexity. We're in a backdrop where we are building a lot of analytics on a very soft underlying data set in terms of robustness or accuracy. And, the researcher in me is just highly dissatisfied with that. So for this audience, I would really encourage you, if you have data that is going to be more useful in any of the different decision-making processes that we're talking about. Again, building a cool tool or interface or analytics on top of that data is a piece of cake. If you don't have that data, it doesn't matter how awesome the interface or the analytics are, because the actual information is just going to be compromised in terms of its value.
So there you go, people with big ideas. There's the voice of the customer. It's the data we need. It's the signals it produces. And I wonder if the members of the audience would have placed these in the same order, and how many of them are actually involved in building nice graphical tools, how many are building operational processes down in the weeds, and how many are building the data sets that drive and help drive investment decisions. So let's move on, because there are other issues that I know we've discussed and that you face. So very often, young tech companies come into financial markets, and there are a whole range of bear traps waiting for them that they simply don't understand. They don't think about. They might have a very, very good data set, but they just have missed the things that are important to investors, and from my point of view, to data vendors who take those data sets and take them out into the market, often for the young startup companies. So what do you think are some of the key issues that people with original ideas make, where they simply don't understand what you do and what's important to you, in not so much in whether it's an ESG data set, but just in how they put things together?
Sure. Well, first I'll acknowledge I'm not the only type of customer out there, so it's entirely logical that the kinds of tools and information that are most valuable for my setting may or may not be the same as someone who is investing in a different way, or someone who's in charge of regulatory reporting as opposed to investment decisions, et cetera. So one trick is to kind of find the audience for the thing, which is really key. But I try to back up a little bit, Kevin. It relates a little bit to your last question. The first thing I ask is this proposal in front of me addressing something that is really relevant for the broader world outside of my own context? Like, can I see a lot of different ways that this could be useful or additive to the giant crowded landscape that we already have? The next layer is whether it's relevant for my specific work, and is that a very obvious, intuitive kind of thing, as opposed to something someone has to give me a 60-minute presentation on before it clicks. So the clarity and the kind of obviousness of that relevance is key. The third element, I feel like should go without saying, but sometimes it doesn't within finance, which is it obviously a legal thing to do? There are a lot of really clever ideas within financial services that are not okay. I kind of wish they were, but they're not. And this is a very easy thing to check at an early stage. Maybe hand in hand with that is this question of domain expertise more broadly. You know, if you're going to offer a climate tool and you haven't talked to a climate scientist, like, it's sort of obvious, and you know, it's a missed opportunity, right? So involving the right experts for whatever it is you're trying to address, and not just one or two, but a pretty broad range. So you're sure you've checked all those potential angles out. And then the last thing is a little more of a design principle. It's especially important in the ESG realm with the challenges of primary data, like we just mentioned. It's really important for our purposes to have pretty complete transparency through to the roots of the process, so we can follow whatever it is that's being layered in and developed along the way. There are an awful lot of tools with an ESG specific bent to them that give you some magical score or ratio or information about your portfolio, and you have no way of figuring out exactly where that came from and why and how that information should be used. Whether analytically there's something there that you might want to address or adjust in a different way. Again, my team is very research oriented, so it's natural that this is where we're focused. There are other folks who don't mind. They just want the answer. But for us, having that transparency and that ability to look all the way through to the primary data that's informing a process that we, you know, work with on the back end is really essential.
And that's an extremely important point. It always takes me back to school, where you're told in the exams, put the working out on the side of the page.
Yeah, show your work, yeah.
Show your work. Because in many instances, I think a lot of young companies don't understand that they may have very good ideas that are very relevant to the work you do or other investors do. If you can see the working out, then you're often able to help them. And certainly we do this. Because it might be a very good idea that just needs a little bit of tweaking. But if you cannot have transparency on the processes, it's incredibly complex. And it's interesting, as a vendor, I am now often in meetings where financial institutions are saying, because of the regulatory pressure, if we cannot have a clear explanation all the way through to the underlying data, we simply cannot afford to use it, because the regulators are pushing us to say, if you're saying it has this impact on your portfolio or your balance sheet, prove it.
Yeah.
And I think that's only going to increase. So that's an interesting point, because we think about data that appears from nowhere and these tremendous data sets that appear to solve all of the problems the world faces. And of course, driving a lot of these data sets is AI. So this is a short question. So do you think AI being used in ESG data collection and analysis, do you think it's a panacea or just a helpful tool? And I'm sure all the AI people in the world will say it's going to solve all the problems.
Yeah, it's a pretty big question. First, I'll note that more than half of what we see that has an AI label or brand to it is mostly machine learning, not capital A, capital I. So that's a pretty important distinction. The thing that I think is really at the heart of most ML and AI approaches that is different in my particular operating setting is a lot of tools in that arena are set up with a goal of having a predictive insight at the end. You know, so we're gonna you know, process all this data, put it together in a really cool algorithm way, and then you're gonna have a signal that has a very specific use case to it. And in financial services, almost always that signal is an alpha signal, and it's something that, you know, you can easily backtest, and that's sort of the holy grail for a lot of folks. Alpha is indeed the holy grail for a lot of folks, but it's so much more interesting to me, to the point of our last question, to see the work, right? Because I'm much more interested in the insight that goes with that prediction rather than the prediction itself. Again, it's a very rapidly evolving set of conditions that we're under. And so like any model, there's a wide range of potential long-term effectiveness scenarios. And in this case, it's probably a wider range than usual. And so I really want to think about the theory and the causality that might be revealed by using these tools. And that's a different starting point than many of the folks who are designing that analysis to begin with.
I could not agree more. The number of AI companies that phone me up and say, can we come and talk to you because we have the big idea. But going back to the broader issue and to help our audience. For anyone building ESG fintech solutions, what do you think the greatest challenges are going to be in ESG investing over the next 5 years? What do you need fixed? You're running billions, hundreds of billions as a firm, dollars of people's money. We're rushing towards net zero. What do you think people who are wanting to provide solutions should be thinking about? What are the big elephants that are going to be in the room in the future?
Glad you asked, Kevin, and it links very much to the potential that sits in that AI ML category in some cases. A lot of what we talked about the first part of this conversation was very structured uses for data. So if you are doing regulatory filing, almost certainly you need structured, potentially auditable, backward-looking, verified information to work with. That's a really important part of the investment puzzle. Again, I don't want to downplay that at all. But whoa, it's way more interesting to us to think about what are the things we don't yet know? What are the things that don't fit very well into that conventional box checky sort of structured data approach? And this is where new tools and new insights, I think, could be incredibly helpful. So let's take a few examples within the E environmental arena and a few within the S arena, which we haven't dwelt too much on. Yes, I really care about net zero plans and if a company is adhering to them over time. What's a lot more interesting to me is if I'm able to see in real time whether a company in a key part of the world who has made a key promise for water stewardship, for example, is actually holding up that promise. There's a million different ways you could do that with alternative data, real-time data, imaging data, and not waiting for the company to issue a report 18 months from now that someone from Ernst & Young verified somehow. Like, all the puzzle pieces are necessary, but if you're looking for insight that closer to complete, closer to real time point of view is something that is largely missing from those structured data sets. So we think for investment merit, the work needs to be context specific, needs to be forward looking. And that backward looking structured data is a very small puzzle piece to get to the context specific and forward looking. Similarly, on the S side, no one, I think, would debate the fact that the social elements of business are just as important as environmental. How is a company going to be successful in its environmental plan? It's the people who execute it, right? So the two really are completely linked at the root level, and yet we sometimes kind of falsely separate them. One reason you often hear less about S-oriented analysis is that the metrics are even harder than they are within environmental. So very little structured data. To the extent there is data, it tends to be very focused on policies and procedures, not at all on outcomes or experiences. Again, the folks who are listening in this community, I think, have an amazing range of insights and capacities to think about how could you measure employee well-being, for example, in a way that is not creepy and also more accurate than what we have now. So there's some big questions that are still largely unexplored in terms of true ongoing analysis and data availability.
That's extremely important, because what you have said to our audience is that you, as a major fund management business, cannot get everything you need and everything you want to be able to do a role as effectively as you would like to. There's a lot there, but it is not the end of the journey. Sounds like it's more like the beginning of the journey. And then just one point you made, I'm going to dive back into E. I'm sorry, I like G as well, but we haven't done much G today. I'm going to dive back into E because you talked about forward-looking scenarios, and our industry is in a very interesting position at the moment, because I think we're going through a fundamental change in the way we have to work, because we've always historically looked for and expect highly structured, highly disciplined, transparent time series. Most of them seem to go bottom left, top right when you look at the page. When they don't, I'm probably more interested than when they do. But we're now having to look forward. We're having to look at forward scenarios. You're having to think as a fund manager about what's going to happen over the next 5, 10, 15, 20, 30 years. You're having to report on that to regulators for all intents and purposes, certainly within the next 5 years. And within that forward looking, there's a huge range of uncertainties. We've learned over the last 24 months We had things occur in the meteorological processes that the scientists, the best scientists in the world, didn't even think were possible and therefore had never modeled. So when you're running your portfolio, your 8 billion, how are you starting to think about looking forward and that imprecise and as we've now experienced, incredibly unpredictable range of items are dealt with? Because you mentioned real time, and that is perhaps, I think, for many fund managers, a domain they're going to have to get much closer to in terms of understanding their portfolios and particularly the E component.
Right. There are a few important vectors that are part of the question here, and I would call upon the work that I've done with the Santa Fe Institute and the lessons I've taken from their scientists over time, both climate scientists and also scientists focused on complex adaptive systems more generally. And the reason I value that science and that whole realm of research is that it complements our traditional, mostly linear thoughts and tools that we have within traditional financial practice. And you highlighted one key element, Kevin, which is that when we want to have forward-looking precision when we're analyzing these issues that are obviously rising in urgency and intensity. It's very natural to want that forward-looking precision. What we actually need to accept, though, is that the range of possible outcomes continues to widen. And it's not very comfortable as humans. It's definitely not comfortable within finance, where you're trained to try to measure everything down to like 2 or 3 decimal points of precision. And so the number one thing I would want to note here is that I think collectively, as a community and as a profession, we need to be really intellectually rigorous in doing that hard and detailed analysis, and also recognizing the limits and the dangers of false precision that are baked into any one set of tools or procedures or reporting mechanisms. So there's an element here that's super brainy and really interesting to think through. There's an element here that's a little more human emotion centered. It feels much better to say, here is our report and we know what's going to happen in 2040, than it does to say, here's our report and here is what might happen in 2040. And yet the second is probably a little more true to life than the first. And so I think defining that range of potential outcomes in a lot of situations is key. Taking a more precise approach to analyzing potential scenarios that might have been considered outliers, but in fact may turn out not to be outliers, is really key. And again, just to link back to the earlier parts of our conversation, I think it's really vital in this arena not to confuse a regulatory answer, a strategic operating plan answer, and an actual scientific answer to these questions. They are not the same thing. They are not substitutable. And to understand the interrelationships between those 3 different perspectives, that's where all the value is. It's also where all the risk is. And so again, I don't want to be only risk oriented in this discussion. If you're willing to address these longer term issues in a more creative, open-ended way, the insights that you can generate are amazing. It's a little more tiptoey feeling than just filling out a bunch of paperwork about 2050, but it's ultimately much more rewarding and I think much more responsible and valuable.
I'm going to have to jump in, Katherine. The organisers of Boston FinTech are flashing me furiously, saying, you guys are enjoying yourselves.
We're done.
And you haven't even started talking about beekeeping yet. So Katherine, on behalf of the audience, I would really like to thank you for your time and deep insights. Incredibly helpful, I'm sure, for people who are thinking of working in this path. So all I'd like to say now is thank you to the audience. And I'm going to hand over to Kelly for the closing remarks. Thank you, everyone. It's been a pleasure to be here.
Great. Thanks, everyone.
Thanks, Kevin and Katherine, for joining us for such an insightful session. We appreciate it. We'll say bye to them and let them go on backstage and get back to work, I'm sure. But again, I'm Kelly Fryer, Executive Director of FinTech Sandbox. FinTech Sandbox has been incredibly proud to bring you this year's Boston FinTech Week. We hope you've enjoyed these 4 days and learned from our speakers. Even though we were virtual, this has been our most engaged and highest attended Boston FinTech Week yet. And all of that is because of you and your energy and an excitement for this event. So thank you for making it what it has been so far. As you can imagine, putting on Boston FinTech Week is no small feat. And we have a very small but very mighty team behind the scenes responsible for organizing the event. So I want to say a massive thank you to our FinTech Sandbox team for putting on such a great event this year. Mike McCluskey, Josie Matella, David Savage, and our greater Boston FinTech Week team, Jim Smith, Luke Lennon, Maggie McDonald, Rachel Feely-Cole, Victoria Chen, Adit Jane, and of course, the wonderful Sarah Biller and David Jagan. FinTech Sandbox is really all about bringing the FinTech community together for the good and supporting FinTech entrepreneurs. And we wouldn't be able to do that without the support of our incredible sponsors who support our mission and keep FinTech Sandbox and Boston FinTech Week going. And then, of course, thanks to all of you throughout the week for joining us. We're so excited that you tuned in and that you got to celebrate the community and celebrate FinTech alongside of us. So we'll close out the event with more networking time, of course. Go check out the networking rooms tab. If you click the little 3 lines at the top of your screen, you'll see an option for networking rooms. Go in there so that you all can continue to make valuable connections and meet new folks within FinTech. Thank you all again.